Of course, I'm here. I may not be saying what you have not had before. So the issue of portfolio management may just be a matter of nomenclature. There are things you just come around every day. So if you are here expecting to hear things that you've not had before, I believe that some of them already, you might have already imbibed them in your practice. So, and at this point, I will start by saying that I made a little adjustment on the topic that was given to me, real estate portfolio management, and I adjusted it to real estate investment and portfolio management. Before I can go further, I would like to make this introduction, not because I want to show off or, present my ego. I'm Dr. Ume Obinna Lawrence, of course, an associate prof, University of Lagos. Apart from lecturing, I had my private practice, Obinna Ume and Partners, real estate. Aside that, I have a company called O Blues. I'm the owner of O Blues, and they are into retail, food retailing. Aside that, I do some importation and exportation of jewelries and wristwatches and gold. So I'm somehow a merchandise. Aside that, I am also the owner of a company, a research development company called Providential Consulting. And we've done a lot of researches for different bodies, individuals, and even for government agencies. And why am I saying this? I'm saying this because in my own little way, this is what makes up my own portfolio. So I'm only saying it because this is what makes up my own portfolio. So, and sorry. So I will also want to say, well, of course, Artbond is not a new name to us. If I am right, I am sure that this company was initiated around 2016, if I'm right, because I remember that you came and you met me and were able to discuss one or two things about the way forward of Artbond. And I am happy today to see the way Artbond has been expanding. And I believe that as time goes on, we will grow bigger than this. So today, if you look at this topic, real estate investment and the portfolio management, you can see real estate there in that topic. You can see investment in that topic. You can see portfolio in that topic. You can see portfolio management in that topic. So we have to look at them one after the other. So what do we mean by investment? And we say that this is the giving up of a capital sum to acquire investment directly or indirectly. When we talk of directly, we are talking about the investment that you manage yourself. Indirectly is investment that is managed by a fund, maybe through the issuance of shares. So in that case, and we say that the essence of having this is for the purpose of earning either income returns or capital returns, or what you call capital appreciation, or total returns, which of course is made up of the income returns and the capital returns. So that is why we own investment. There is no gains without pains. So we are simply saying the ideology there is that you have to make sacrifice today for you to enjoy in the future. So we also move on by saying what are the types of investments And we say that these investments can either be financial, it can also be non-financial. And we mentioned the examples. Of course, these are not exhaustive of financial investments, which include shares, bonds, and other paper assets. Even cash is an investment. So there may be countries that will see the way you keep cash as not appropriate. But if it's not seen as not appropriate and is acceptable, today we know that the value of Naira is going down and that the value of dollar is going up. And that will tell you that so many individuals, apart from companies, are buying dollars and they are keeping it at home. And that is their investment because it's growing on a daily basis. Few years ago, as at last year, dollar was around 7 something. Today we are talking about over 1,360. So, and as at last week, dollar was about 1,265. So you can see the pace at which it grows. So you can also see that cash can be an investment. Then when we look at the non-financial investments, then we have things like movable and immovable properties. Of course, when we talk about movable properties, we are talking about chattels, assets that you can carry from place to place. A typical example of immovable property is a real estate investment. So some of the movable properties we mentioned there are the gold, which of course I tell you I deal on. The diamonds, sustainable jewelry assets, the ones that are sustainable. You know what I mean by that, that can stand the test of time. Then direct real estate investment. So we now move on to the meaning of investment portfolio. Of course, we have the old definition, which is, of course, is a collection of valuable papers and documents found in metallic briefcases. Those olden days, you see people when they carry those metallic briefcases, they are seen as big men. But in this present generation, who is carrying it? Who is talking about briefcase? What we are talking about today is cash. And we are not talking about just having cash lying idle in the banks. We are talking about the cash that grows. And that is what most investment companies are looking at. The cash that does what? Grows. You need a capital base that grows. You need a capital base that does what? That grows. So, but over time, of course, I've already started talking about the modern definition. And we see a portfolio as a set of 2 or more investments under one managerial entity. So you can see why I introduced myself in different ways, talking about different things that I handle. So I'm already living by example as an individual. So even as a corporate body or as a company, you are expected to have more than one business venture that you are into, more than one type of investment that you are dealing with. So it's under one managerial entity who monitors the individual performance of the investments, but ultimately concerned about the common optimal performance of the investment. What we are saying is that a portfolio owner looks at his portfolio as if they are one, even though that there are different types of investments that make up the portfolio. Just like you have the rainbow, you have 7 colors in a rainbow, but it is only one rainbow. Each of these colors have a role they play in adding to the aesthetics of the rainbow. That same thing applies when you have portfolio. You have different investments, but under the same management. So we move on. We have types of investment portfolio, which can be direct investment portfolio. And I can, of course, say when you are talking of direct investment portfolio, it involves efficient stewardship. You are not outsourcing the management, do you understand, of your fund, or you are not outsourcing the management of your investment. That means you are in direct custody of the investment. You handle them yourselves. But when we talk examples of those ones, some of them may be tax friendly, some may be cumbersome, some may be marketable, Of course, in the area of real estate investment, direct real estate investment is capital intensive. It's capital intensive and is usually illiquid. Liquidity is talking about the ease with which an asset can be converted into cash. So in most cases, it's usually illiquid. It takes a long time to sell. So, and the management is cumbersome. Okay? The management is cumbersome. But one thing we'll enjoy for both, whether it's direct real estate investment or indirect real estate investment, is that there is security of initial capital. Because we have found out that in most cases, that property usually appreciates. So it can either appreciate in two ways. It's either appreciating in nominal terms. That means you are breaking even. But we are not just workaholic to break evens. We are interested in making gains. So we must ensure that whatever we embark on, in the case of indirect investment, we should ensure that the investment appreciates in real terms, not in nominal terms. And of course, you know the difference, that if I've invested 20 million today in real estate, and tomorrow, and maybe that 20 million can buy me a Prado Jeep. I'm just giving an instance. And tomorrow, the property has appreciated to 30 million, okay, or 40 million. It's like as if there is growth. But what if that 40 million can still buy me a Prado Jeep in future? I have not grown my business. There is no return. It only appreciated in nominal terms because it can still buy the same thing. But if it can still buy me that Prado Jeep and still give me change, that means that I have made gain. So, but if I have not gotten anything additional, it only means I have broken even. So we are not here to break even. We are here to make gains, to make profit. So having said that, that is why we mentioned that investments will have to hedge against inflation. Then we talk about the indirect investment portfolio. Of course, as it relates to real estate, this one in most cases does not require efficient stewardship on the part of the investors or client investors or the stakeholders or the shareholders or the bondholders. But the fund that manages these investments, do you understand, takes up the responsibility of efficient stewardship, takes up the responsibility of management from the shareholders or stakeholders. So, but one of the things you may find out is that it has some features of conciliability, unlike in the case of direct real estate investment. In the case of direct real estate investment, your property is physically on ground. One, we say one problem is that it's capital intensive because you are not sharing the cost with anybody. Two, they can see where your property is located. But when you get involved in the indirect real estate like REITs, investing with REITs, real estate investment trust. Of course, in Nigeria, we have presently the SFS Real Estate Investment Trust, UPDC REITs. You have a UACN Property Development Company. Okay, then plethora of others. You even have the Union Home REITs. So we also talk about consistency of reward in the case of indirect real estate investment. We are saying that we may have consistency of returns. We may not. Because there are some times even you realize that some companies that are quoted with PLC, they don't declare dividends because they didn't make any gain. So there is no consistency on return on the part of the shareholders. So it also depends on the company and the strength of the company. Do you understand? So most of these things are under probability. So, but when you look at the indirect real estate investment, we are saying that the investment companies that handle these investments on behalf of the shareholders may be a PLC. It may not be a PLC. Some of the PLCs started as not being a PLC. Do you understand? That is a company that is quoted with Nigerian Stock Exchange market. That's what we refer to as publicly limited liability companies. So, and I know that one day Adbond will also get to that level, because as time goes on, we may also have to look at some of the importance of PLCs. So examples of companies that we may have under indirect investment are agro companies, real estate companies. I mentioned some insurance companies like Asamansard Insurance, capital, insurance companies, mutual benefit assurance. Then for the oil company, you have Miss Oil, you have Corn Oil, and the rest of them. For construction, you have Abico, you have Julius Berger, and you have Smart Production Properties. Smart Production Nigeria. For banks, of course, it can either be mortgage banks, it can be commercial banks. Example, Zenith Bank, what do you call it? UBA, Union Banks, and the rest of them. Then for other investment companies. So now we come down to the meaning of real estate investment, and we define it as the giving up of capital sum to acquire real estate investment directly or indirectly for the purpose of earning income, returns, or capital gains. So we've come across investments, now we related it to real estate, and the definition is almost the same. So, but now we are looking at the types or kinds of real estate investments. Okay, so we captured residential real estate investment, we captured commercial real estate investment, we captured industrial real estate investment, agricultural, recreational, and taxable religious real estate investment. So those religious buildings that you find out that they generate income. That's why I call it taxable religious real estate investment. Then in the area of agricultural real estate investment, now there are schools of thought in that, because some believe that agriculture will not fall under real estate investment. But there is this adage that says, quick plantator, solo shady, meaning that whatever that is affixed to land belongs to land. So whatever you do on land is part of the real estate. So, and that was why we captured it there. And these are different types of real estate investment. Apart from the different types of real estate investment, I may deviate a little by telling you that there are other types of investment outside the purview of real estate investment. Maybe, for instance, you take shares. You have the cumulative shares, you have the preference shares. So you have the cumulative preference shares, you have the preference shares, you have the common or ordinary shares. Even bonds, you have variant types. So now, what we are saying is that what can be a kind is contextual, depending on where you are looking at it from. Because the kinds of a type refers, of course, to the subtypes. And in this case, the subtypes of real estate investment, when you pick residential, it can be a maisonette, it can be a duplex, it can be semi-detached house, it can be terrace buildings, it can be tenement buildings, it can be blocks of flats. When you pick agricultural, you can be talking about economic plants or cash crops. You can also be talking about food crops. Okay? So, and even under that, you may be talking about a situation. You have mixed cropping, mixed farming, still under agriculture. Then you come to commercial, you can be talking about offices and also shops. There are more to that. What I have said is not exhaustive. So we move on to the real estate investment portfolio. Of course, there is no old definition of real estate investment portfolio because it's a recent concept and application. Okay, but the present definition we know today, in line with that same definition of portfolio, but as it relates to real estate, is that it is a set of two or more real estate investments under one managerial entity who monitors the individual performance of the investment, but ultimately concerned about the common optimal performance of the investment. So to ensure optimality, ideal investment selection are made in the face of plethora of investment types. And we have mentioned that there are plethora of investment types. We even mentioned few, we didn't exhaust. So That tells us that the philosophy of real estate portfolio management, the essence is to bring together real estate investment in different markets with different risk-return characteristics in order to spread risk and maximize return. Hence, the popular adage that you don't put all your eggs in one basket. So what you need to do is that we need to get to that level where the capital base of the company is very strong. I want to tell you something, deviate a little. Of course, I'm a lecturer in University of Lagos, and before I started most of this business I told you I do, somehow I was contented with my salary as a lecturer in University of Lagos, and we just call it fulfillment. But I have a friend, of course, named Nonso Okpala. When they started VDF Group, he told me, and I was like, this man is over dreaming. You must have heard of VDF Group. They won an award last year amongst of all the quoted companies in Nigeria. He was my schoolmate, and they just started this, few of them, about 3 of them, with about 1.5 million, which is not much. And what were they doing? They were giving short-term loans. And I was like, how do they intend to grow this company? But as at last year, VDF Group is boasting, as at few years ago, VDF Group is boasting of a capital base of 29 billion naira. And when I heard that, I shouted, what am I doing in the classroom? I dropped my pen immediately. And that was how I started my merchandise business. And I realized that there are windows of opportunities everywhere. You can explore the world, and you don't have to say that you are contented with what you have. Yes, you are contented with what God gives you. But the most important thing in life is that we must have to grow. I am happy when I received a vest from Adbond, captioned what? Grow to change, or change for growth. What was it again? Grow for change. That means that this company is also a flexible company that is ready to grow. Do you understand? You may have a vision. Agro homes, to provide agricultural land for people with the intention that in future they may become homeowners. Right?
Yes, sir.
That is the vision of Adbond. Am I right? Yes. So, but I am telling you that there is also nothing wrong when the vision changes. Because there are companies that started with a vision along the line because they needed to expand in schools for those that want to do farming business, and training schools for other areas of skills and training. So I will come to that. So now we go back to the problem of selection. You are not just selecting. You have to select those investments that have the attributes to satisfy the investor's objectives. Assuming you are a fiduciary or a trust or a fund, and you are managing investments for people, then you have to select those investments that have the attributes to satisfy the investor's objectives, especially in the area of agriculture. You want to do farming business, and people are buying plots of land, and you are providing them with farm managers. Am I communicating?
Yes, sir.
You don't just plant any crops because you are only a trustee, and you are not a discretionary trustee. You are a non-discretionary trustee. That means you have to carry your clients along to know what they want. What kind of plants should we cultivate? If it is real estate, you need to know the objectives of the clients before you embark on any project, because they are the engine room of your capital base. And that is what Lashon is also doing. Sorry, I'm using them, but you need to also understand who your competitors are, because it's only when you know them that you can now come up with a brand that will outcompete them in the market. So it is the duty of Adbond to find out what other people are doing. Then think of what you can do which other people are not doing, which is also need-oriented. So that is what you have to consider in selecting your investment. Then we talk about the problem of timing. So every investment has periods of gains and booms. Every investment is not affected the same way by a given state of the economy. Am I communicating? They are not affected in the same way by a given state. There is a state of economy. There is an economic situation you will see that will favor one investment and will not favor others. So you know when to discard. There is a time to sell off an investment. There is a time to retain an investment. There is a time to purchase an investment. You need to understand that. The time to buy, the time to sell, and the time to retain. It is an indirect investment. Of course, you will sell, just like people, you will sell when the price is doing what? You sell when the price is high. Then you will retain when the price is going up. Then you do what? You buy when the price is low. That's what we are saying. Then we have the problem of allocation of funds. Of course, as an investment company, there are two possible kinds of fund you may have, which is the equity finance and the loanable fund. The equity finance is the personal fund, the fund the company already has, or the fund, of course, but the loanable one are borrowed funds. Even the pool of funds that you get from members of the public are still loanable. Do you understand? You are standing in just as a trustee to these shareholders. So these are the two possible kinds of funding you will have. But what we are saying is that the fund is limited. It's limited. And there are plethora of investment options. So when you want to select, you have to select well. You have to select ideally. And when you want to allocate fund, the problem of funding is asking, how much do I allocate to each of the investment vehicle options that I have selected? Of course, I won't be telling you much about that. We can do that using some analytical tools, which I am not to present today because it might consume time. That is for another lecture. So, now, real estate diversification decision strategies. The diversification strategies include diversification by geographic or economic type. So, and I have mentioned, I am happy if I am right that Adbond today have land in Ogun State. Adbond today have land in Ibadan. Am I right? Yes. So, you may be wondering how I'm getting all this information, but Adbond has become a household name. So you are here, you don't know what you're enjoying, and I call Adbond outside there, and people are telling me that they know about it. Somebody is telling me about Adbond in the United States of America last week. So you are growing. You are growing. So, and that is what we mean by diversification, geographic type. I have mentioned Lashon, how they are spreading all over the world. So you can spread at the metro level, meaning at the local government level. You can spread at the state level, meaning that you might have Adbond just like you have now in Ogun State and you have in Ibadan. You can spread at the regional level, meaning that you have to explore the northeast, the north central, the southeast, the south-south. You need to grow. We are talking about growth today. Then you can also have your property type, diversification by property type. And we are telling you that no two properties are in the same market by virtue of location. And if they are in different markets, it means that the returns coming out from them too differs. So they have different risk-return characteristics. So for you to spread this risk, you have to diversify by property type. Okay? Because they're in different markets. And what we are trying to do is that when one type of investment is not doing well, the other one that is doing well is compensating for the loss, so that there will not be total ruination of your investment. And that's why we started by mentioning the adage, you do not put all your eggs in one basket. So even in the case of geographic type I mentioned earlier, the risk attachments are different. You may have a situation that you have, God forbid, buildings in a location, and maybe there's this fire that come and it gutted the whole buildings. But because you have in other locations, you'll be compensating for the loss. So I am not saying that fire is going to affect your building, but I am giving you an example of risk. It can even be a natural disaster. It can be anything. It can be government policy saying that, look, we want to demolish here. So you are trying to spread risk. Okay? That's the essence of diversification, and that's the logic behind portfolio management. Then we have to look at diversification by lease arrangement. Assuming you have properties that you are leasing, because I know that one day Adbond will start building. Lashon has started building. So, and how will Adbond start building is that some of those land you acquire, at a point in time you will say that one is already ripe for development, for people that bought into those layouts to come and start developing. One of the things that encourages people to develop, which Lashon has been exploring, is that they will look for fund, pool of funds from members of the public subscribe. They will build in that estate like 10 or 15 buildings, which will attract others to come. Okay? Am I communicating?
Yes, sir.
They might even put a fence, general fence. You acquire a common CFO, and they have prepared the site. People know that there is hope for life in that environment in the near future, and they start subscribing. And how do you achieve that? It can even be a group of people. I'm not here to teach you marketing, but I'm telling you that you can visit some places, maybe like, okay, young people that are coming up that are so eager to have their properties. You can visit youth camps or am I communicating?
Yes,
Church places that there are people. They meet them as a group and market what you have. Tell them about the potentials of that estate. Do you understand? The likelihood that buildings will start springing up there in the near future, and there will be in fact that there is even buildings on ground. So you have to explore that area. Then we have diversification by ownership structure. It can be a partnership work. It can be that Adbond just own their own properties. But partnership means that you partner with other organizations or financiers to put up this structure. Okay? Or property developers to put up those structures. Then you have the managerial type. Diversification by managerial type is talking about investors that subscribe to investment from different companies. Okay? Subscribe. So Adbond can decide, in as much as you are an investment company, to also subscribe from investment from other companies that you know that they are blue chip companies that are doing very well. So because you need to build a capital base, it is not just all about paying salaries. To ensure the sustainability of the company need to have a strong capital base. So you need to grow what? Income. You need to grow income. Then we talk about diversification by financial source. Of course, when you are getting equity finance and loanable finance, that's what we are talking about. By life cycle, then in that estate, you may have buildings, you may have bare land, you may have some plots that you have even put up foundation. You leave it at foundation level. It is not in the same market with the bare land. You already diversification by life cycle. You may have another plot that you come there, you put the foundation and you raise the wall to the lintel level. It's not in the same market with the one that only have foundation. You know, they will command different prices. Yes. You have another one that you have, of course, put the roof, but it's still in carcass form. It's not in the same level with the one that is not in carcass form. Then you may have the one that is already rendered and painted. So you are trying to bring in life there and to encourage people and to incite people to come and do what? Develop. So we have the traditional strategies and the modern strategies in diversification. And one thing about the traditional strategies is that it's based on rule of the thumb, method, subjective because we don't know what the person is actually doing. Implicit, of course, you don't know what, simply, very simple. So somebody will come doing investment analysis for you. He will be telling you, invest in this property, invest in that one, invest in this one. But when you ask him why, he's not telling you. Everything is subjective. It's not transparent. But we are talking about portfolio managers that will tell you where to invest and why you should invest in those places. And that's what modern portfolio management emphasizes on. And for them to do that, you use analytical tools, statistical tools to do those analyses. But I'm telling you that today that we are not measuring or discussing on those statistical tools. I will only highlight on them. Some of them are correlation, and correlation is used to determine the best combination of investment that will satisfy the investor's objectives. Then you have the coefficient of determination, which of course is correlation squared, telling you how how a unit change in market index return affects the return of individual investments. Then you have the beta, which is talking about the sensitivity of an individual investment to a unit change in market index return. Then you have the covariance for measuring risk in portfolio. You have the averages for determining returns at the individual investment level and also at the portfolio level. So when you want to determine portfolio returns, you have to determine the returns of the investments that make up the portfolio individually before you now determine the return of the portfolio holistically, because we are told that you have to look at them as if they are one. But you cannot determine the portfolio return holistically without first determining them individually. And for you to determine that individually, of course, you use geometric or arithmetic mean. We are not doing that here. But at the portfolio level, you use the weighted average returns. Then you have the capital asset pricing model, which helps us to determine what is an optimal portfolio. When you have a set of investments, the one that you will select that will give you the optimal portfolio. That's what capital asset pricing model does. So it ranks the investment and tell you the best that will form a portfolio. Then you have the arbitrage pricing model, which tells you that you can use the same amount of fund to achieve greater return. So all you need to do is that as you are reshuffling the combination of the investment, you may find out that without altering the fund, you may find out that at a point in time, your return is increasing. Then you go for the one that gives you the highest return with the same amount of what? Amount of fund. So that's what we are saying. So all these are analytical tools, and I believe that one day or the other we may have time to look at them. Trenor Index does the same function with capital asset pricing model. Then Jensen Index is simply telling you that that value in a regression model, that value of y when x equals to 0, and x here refers to the market index return. We're saying that in the global economy, even if the market index return does not grow, you will still make return from your investment. Okay? But beta is telling you that there is a return you enjoy as a result of growth in market index return. Market index return is talking about the systematic the return that happens in the economy, the GDP. Okay? So that when the GDP increases, that there is a return that comes from individual investment as a result of that increase. But this one is telling you whether there is increase or no increase, you have a return. Okay? So when now increase starts coming in, unfortunately I can't illustrate. When now increase starts coming in, it brings additional returns. Okay? So Then we have the risk-adjusted rate of returns. All these are used for investment selections. So we move on, so we don't waste time here. What is the concern of a fund or portfolio manager in real estate diversification? The fund or portfolio manager in a fund are concerned more about selecting optimal investment needs, which refers to those sets of investments, including the real estate investments, having market or risk return characteristics that the combination will bring about the achievement of clients' objectives and goals. We have said that. Then we move on. Then decision management levels in fund or investment company. You talk about the tactical decisions. Found here are the portfolio and facilities managers. Of course, you may have facilities managers in your company. You may have portfolio managers as well. Okay? So there are who make short-term decisions and decisions on aspects of the fund. But for the strategic decisions, that's where you see members of the board of directors, they are higher cadre staff, okay? The owners or the founding fathers of the company, okay? And the shareholders, because they are the owners, they're actually the owners. The trustees, okay? So they make long-term investment decisions and and decisions that borders on company policies and how the company will grow. Okay? So now, I know that Adbond is not a pure property investment company, but dealer developers, because you sell land for people to build, right? You don't build to collect rent. Am I right? Yes. So if you build to collect rent, am I communicating? That makes you a pure property investment company. Okay? So you are dealer developers. That does not mean that you are not investors. Okay? Am I communicating? So in that particular scenario, when you acquire a land, of course, and you want to put up an estate, people will come and buy into that land. And that is where your investment may likely end. Every other thing you are doing is to get profit for the company. Okay? So you may have facilities managers who handles the estate. And through facilities management, they generate income for the company. Am I right? So that is what you'll be doing. So the facilities managers can come in. But in a situation, you have scattered your investment, you have a state here just like Lashon, you had there, even just like Adbond, you start having estates different places. Or even start having agricultural land different places. Then there should be a portfolio manager who advises Adbond on which site to acquire more land. So the portfolio manager operates at that level because the work of a portfolio manager is to select the best investment mix that will make up the portfolio. But at the strategic decision level, you have members of the board of directors who does approval. The owners, whether you are managing it on their behalf, they are still shareholders, they are still bondholders, they are still stakeholders who own the business that you manage. They make decisions. So, and that means that occasionally you'll be calling a meeting called the annual general meeting. You can decide to make your own periodic to hear from these stakeholders because you are actually a trustee working for them. So what you play in that situation is not a discretionary role, because when a portfolio manager is playing a discretionary role, it means that he takes decision on behalf of the client without even telling them, because the client has handed over a power of attorney to go ahead and do so. But if you are playing a non-discretionary role, then you must carry the stakeholders or the shareholders along. There might even be scenario where you are playing an advisory role. Am I communicating? So these are some of the things that you need to know about this. Then management of real estate investment portfolio management. So I think we have said some of these things, that some of the real estate portfolio management tasks we mentioned: decisions about investment mixes, matching of investment attributes to investment objectives. We said that. Matching of investment objectives to firm policies, selecting investment, allocating assets, timing investment, assessing risk against return. We've come across that. So what is returns? So what are these returns we are talking about? They are not profits. They are not profits of the company, but percentage of the total cost of investment that accrues back to the investors. So these investments returns can be of three types: the income return, total return, and the capital return, which we have mentioned. Then we have the risk, which refers to the variability of this return, because return is not consistent. It varies from time to time. Then phases of investment portfolio management. We have the security analysis phase, which of course we have the fundamental, the technical, and the efficient market hypothesis. So we talk about fundamental. The fundamental analysis is telling you that they are fully acquainted with some investment and will be able to tell you the intrinsic value. So that when the market price of an investment exceeds the intrinsic value, it means that the investment is overpriced. But the technical analysis is telling you that the returns of an investment in the past will continue in the future. And if it continues in the future, that there are statistical tools that you can use to make projections accurately, especially the least square method statistical tool. Now we have also the market hypothesis analysis, telling you that, look, that they are neither here nor here. Why? They are saying that the market price of every investment reflects the true intrinsic value of that, because before people can buy, they will have knowledge of what they are buying. Does that really apply in Nigeria? No, because most property data in Nigeria are hidden. Okay, but there may be circumstances, environment, this hypothesis may be right. So, and also the market hypothesis analysis kicked against the technical analysis, telling you that returns on investment are not consistent. So you cannot talk about that the return of investment in the past have been consistent. Based on that, you will have accurate projections in the future, because in real life they are not consistent. So this one applies to be more selected among various schools of thought. So we have investment portfolio analysis, which of course the second phase talks about feasible portfolio. So we are saying that you have 20 million, which of course incorporates the equitable fund and loanable fund. When you have 20 million, you cannot embark on a portfolio that will consume 50 million. So you have to work with the resources at your disposal. So the feasible portfolio are only those investments that when you check the cost, it will fall within the financial resources that is at the, it will fall within the resources that the company has to expend on it. So then we talk about investment portfolio selection. Then we are talking about the efficient fund share analysis and utility portfolio analysis. So the efficient fund share analysis is telling you that you have every investment has risk return characteristics. That there are some investments that when the return is increasing, the risk is also increasing. They fall within the efficient line. But there are some investments that you find out that when the risk is increasing, the return is not increasing. They fall under the non-efficient line. So you have to select those ones that fall within the efficient line. So amongst those ones that fall within the efficient line, if they are 30, but you only need 10 in your portfolio, do you understand? How do you now get 10 out of those 30, since they are all efficient? Is to do a utility analysis. And utility analysis is telling you that different investors have different risk tolerance capacity. Some investors are risk prone, some are risk indifferent, some are risk averse. So depending on whether you are dealing with investors that are risk prone, risk indifferent, or risk averse, it will help you to make your choice of investment. So because you're actually working for the investor client. Then you have investment portfolio revision. That is when you look back, okay? Monitoring optimality with changes in economic situation, financial markets, and other investor related changes. Then you also have the portfolio evaluation, assessment of performance at periodic intervals, involving actual an expected performance. So because there is a performance you're expecting, you need to check back whether you achieved the expected performance. So we move on. Importance of portfolio management to add bond, harvest, and homes. So, and I'm telling you today that when you incorporate portfolio management, because you may be doing it, but you are not conscious of it. But I know that after this lecture, we'll be very conscious of it. Look at the benefits, especially when you also quoted with PLC. It will increase portfolio of clientele resulting from risk minimization. So when these companies knows that you are doing risk management in your company, it will increase what? Portfolio of clientele. The number of clients coming will increase. Increased portfolio of clientele resulting from increased return on investment for the client. When you are doing analysis before you venture into any investment, it will help you to know the investments that you select that will give you the maximum returns. It will increase clients' confidence resulting from high level of consistency in having an optimal portfolio. Okay, then I continue. It will enhance the corporate identity of the company, which is talking about your brand. Okay, then it will increase the high capital, it will give a high capital base of the company. We're talking about high capital base when you're expanding and you are getting pool of funds from members of the public. Then large fund capital. Okay, then economies of large scale, effectiveness and efficiency in investment decision making, transparency and accountability to clients and public, then well-informed staff of Adbond Harvest on the new trend in real estate practices, mature markets and emerging markets, then trained staff with better skills and knowledge on how to break even and make profits for the company. Okay, then increased remuneration for staff, because you cannot just be workaholic. You are not Father Christmas. So when you are working for a company, don't think that you are working for the founders of the company. You are also working for yourself, because if the capital base of the company grows, your welfare too will improve. Okay, then I now say increase records of real estate data on rents and prices for purposes. I'm coming back to this, please. Records of real estate data on rents and prices for purposes of direct or indirect real estate investment analysis. Still more recommendation, religiously maintaining that there is a separation of operating cost and profit of the company from the returns on investment. Please take note of that. The profit of the company is not the same thing as the return on investment. Engaging the staff in consistent training in order to meet up with the current challenges of competitive investment world. That is what we are doing today. It's part of it. Start exploring the area. This is an advice of share funding to increase the capital strength of the company and thus more open doors for new areas to diversify into. I want to say that we are talking about, with this last point and the one I said I will earlier come to, we are talking about a company today that will outlive its owner. And that is why Adbond has to grow. It is not a company that if tomorrow they look for the owner, the company collapses. So if you are working in this company, you are not working for the founders. You are working for yourself. We pray that one day Adbond will also become a PLC, public limited company. Okay? So that means that if they look for the founders, the company continues. And there's this kind of assurance it gives to the staff that the company is sustainable. So we are talking about a sustainable company. And I want to make that recommendation strongly that Adbond start looking at that angle. Do you understand? To see how this company will outlive the owner. You may think that it is not to the advantage of the founders, but do you know the advantage of a company outliving the owner? Is that even when the owner is no longer alive, they are still calling the founder, because the company did not die. The owner is alive forever. That's the essence. The founders are alive forever. Anybody that passed through that company that has made a serious impact in that company will always be remembered forever. Well, till thy kingdom come. Let me just put it like that. So this, of course, is the little that I have to say today. There are more recommendations, and I can only say at this point, thank you for listening and remain blessed.